Good morning, everyone. It's Wednesday, January 14th, 2026. If you're watching this, you're likely trying to make sense of the sea of red we saw on Wall Street yesterday and the mixed signals flashing across global screens this morning. Just 24 hours ago, we were celebrating fresh record highs. Today, we're digesting a complex cocktail of inflation data, a rocky start to bank earnings, and some aggressive political rhetoric that sent shockwaves through the payment and energy sectors. In this video, we are breaking down everything that impacted markets in the last 24 hours, from the CPI print that has the Fed in a bind, to the political comments that tanked Visa and Mastercard, and the crypto breakout that sees Bitcoin testing critical resistance. Let's dive into the numbers. First, let's look at the damage on the boards. After hitting intraday records on Monday, U.S. markets took a breather yesterday, Tuesday, January 13th. Here is where the major indices settled at the closing bell. The S&P 500 slipped 0.19% to close at 6,963.74. We are flirting with that psychological 7,000 level, but couldn't hold it yesterday. The Nasdaq Composite was the most resilient, down just 0.1% to finish at 23,709.87. The Dow Jones Industrial Average took the hardest hit, shedding roughly 400 points, or 0.8%, to close at 49,191.99. The Russell 2000 also saw pressure as small caps reacted to interest rate uncertainties. Overnight action in Asia. Moving to the action happening right now in the East, Japan is the outlier. The Nikkei 225 surged 3.1% overnight, smashing a new intraday record of 53,814.79 as trading resumed after a holiday. Japanese investors are piling into tech, playing catch-up with the U.S. semiconductor rally. Meanwhile, Hong Kong's Hang Seng gained about 1%, while mainland China's Shanghai Composite remained flat. European Open. European markets are currently trading mixed to lower as traders there react to the weak lead from Wall Street banks. Now, let's talk about the main event that everyone was waiting for. The December Consumer Price Index report released yesterday morning. The numbers were complicated. Headline CPI rose 2.7% year over year, which matched economists' expectations exactly. Core CPI, which strips out volatile food and energy, came in at 2.6%. This was actually a slight beat. The street was fearing a 2.8% handle. The market interpretation. On the surface, this looks like a Goldilocks print. Inflation is stabilizing. However, the market reaction tells a different story. With core inflation stuck above the Fed's 2% target, the bond market is signaling that the Federal Reserve may not be in a rush to cut rates further at their January 29th meeting. The 10-year Treasury yield held steady around 4.18%. Traders are now pricing in a wait-and-see approach from the Fed, especially with the Fed funds rate currently sitting in the 3.5% to 3.75% range after the December cut. The consensus is shifting. We might not see another cut until later in Q1 or Q2. The drag on the Dow yesterday wasn't just macro, it was corporate. We officially kicked off Q4 earnings season, and the banks stumbled out of the gate. JPMorgan Chase, the biggest bank in the US, dropped over 4%. While they beat on adjusted profit, revenue came in light. CEO Jamie Dimon issued a cautious statement, warning that while the consumer is spending, geopolitical conditions and sticky inflation remain hazards. When Jamie Dimon gets cautious, the market listens. Tech and AI. The divergence while banks bled, big tech, specifically AI chips, continued to party. Intel rallied 7.3%. AMD jumped 6.4%. Both stocks were upgraded by analysts yesterday, citing stronger than expected demand for AI servers. This divergence is the story of 2026 so far. Old economy struggling with margins, new economy surging on capex demand. This is where things get really interesting. Politics played a massive role in yesterday's price action, specifically comments coming from President Donald Trump. 1. The credit card cap bombshell. Over the weekend, President Trump suggested a policy to cap credit card interest rates at 10%. The market reaction yesterday was violent for payment processors. Visa dropped 4.5%. Mastercard fell 3.8%. Jamie Dimon explicitly pushed back on this in his earnings call, stating such a cap would damage the industry and reduce consumer spending. This is a developing legislative battle you need to watch closely. 2. Geopolitics and oil. We also saw a spike in oil prices. Brent crude pushed back above $64, and WTI rose 2.5% to $61 per barrel. Why? President Trump stated yesterday that any country doing business with Iran would face a 25% U.S. tariff. This renewed tension in the Middle East is putting a premium back into energy markets, just as we thought supply was stabilizing. 3. The Powell investigation, and we can't ignore the elephant in the room. News broke earlier this week of a Justice Department investigation into Fed Chair Jerome Powell. While the market largely shrugged this off on Monday to hit record highs, it adds a layer of institutional uncertainty. The independence of the Fed is under the microscope, and in a year where rate policy is delicate, this is a major risk factor. Switching gears to digital assets, crypto is ignoring the stock market gloom. Bitcoin is currently trading in the $92,000 to $93,500 range, up roughly 1.7% in the last 24 hours. The chart looks incredibly bullish, consolidating just under that psychological six-figure mark. Why the rally? 2 main drivers. The Clarity Act. The Senate Banking Committee released the text for this new bill, which promises to shield non-custodial developers from money transmitter rules. The market views this as a massive win for DeFi innovation. Rotation. With banks stumbling, we are seeing a rotation of capital back into hard money assets. Altcoins. It wasn't just Bitcoin. Dash exploded 55% and Monero is up 20%, signaling a renewed interest in privacy coins amidst the regulatory chatter. Spot Ethereum ETFs are seeing steady inflows, though ETH is lagging BTC slightly in momentum. A quick check on commodities before we wrap up. Gold pulled back slightly from its record high of $4,644 per ounce, trading around $4,590 per ounce. It's taking a breather, but remains the ultimate hedge against the geopolitical friction we just discussed. Silver outperformed, rising 1.6% to over $86 per ounce, hitting fresh all-time highs. So, what is the takeaway for today, January 14th? The market is in a tug of war. On one side, you have the AI supercycle keeping the Nasdaq afloat. On the other, you have political risk and earnings reality weighing on the Dow. Actionable next step. Keep your eyes on the Producer Price Index data coming later this week. If wholesale inflation comes in hotter than consumer inflation, it could squeeze corporate margins further. Bad news for stocks that are priced for perfection. Also, watch the 6,950 level on the S&P 500. If we break below that, we could see a deeper correction to the 6,800s. That's your detailed report for today. If you found this breakdown helpful, hit that like button and subscribe for tomorrow's update. Stay liquid, stay sharp.